Good morning and welcome to the Basic Bookkeeping Series. My name is Mary Jo Williams. I will be your moderator for today's session, and I want to welcome all of you here. For those of you that are new to the Virgin Islands Small Business Development Center, let me give you a little brief information. The Virgin Islands Small Business Development Center is a joint venture arrangement between the U.S. Small Business Administration and the University of the Virgin Islands. And as such, what we do is we provide technical assistance for people that are thinking about starting a business, for people that are in business and want to grow their businesses, as well as for people that are in business and now they want to go out of business. So anywhere along that continuum, the Virgin Islands Small Business Development Center is here to help you for the life of your business, not just to get started, not just to get a loan, but for the life of your business. For as long as until you no longer qualify as a small business, we're here to assist you. Our counseling services are at no direct cost to you because we are your tax dollars at work. So please feel free to register at our web portal to become a client if you haven't already, and take advantage of our services. The Virgin Islands Small Business Development Center is located in Estate Peters Rest in St. Croix, right next to Sprint. And we're located on the second floor of Niski Center, above the Marine and the Navy recruiting offices. We are working with people remotely, okay? So you cannot walk into our offices and see a counselor, but call us, email us, and we will make time to speak with you so that you can start accessing our services. Now today we're in for a treat because we have Miss Carmen Acevedo Adams, who's a bookkeeper, and she's gonna be our presenter today. Miss Adams has worked as a bookkeeper for over 25 years. Her clients range from restaurant owners, contractors, EDC companies, nonprofits, and homeowners associations. As a full charge bookkeeper, she has worked on accounts receivables, accounts payables, payroll taxes, monthly, quarterly, and yearly local and federal tax reports, posting to daily sales, bank reconciliation, and general journal entries. In 2016, Ms. Acevedo Adams started her own business as a full charge bookkeeper. She currently works as an independent business contractor for the VI Small Business Development Center, as well as an English-Spanish, Spanish-English interpreter with local attorneys and other businesses. She loves what she's doing and truly enjoys helping people understand the importance of good record keeping for their financial well-being and for their businesses. Now, for today's session, we're asking that you put your questions in the chat, okay? And we will answer the questions as we go along. And also in the chat, there is a copy of the presentation. So if you want to download it and take notes as we go through the process this morning, feel free to do that. Okay, and with no further delay, let's present Ms. Carmen Acevedo Adams. Ms. Adams?
Good morning, everyone. Happy to have you here. We were going to ask you just two questions, I believe, right now, just so that I can get an idea of who I'm speaking with. So Mary Jo, I don't know if you could put those poll questions up.
Ms. Industrious, can you help me out, please?
Okay, the first question is, are you in business? Are you a business owner, or are you someone that is interested in starting a business? It would be very helpful for me to know that. I will make a note of that.
And we'll give you a few more seconds to answer the question.
That's good.
Okay, can we end the poll now, Ms. Industrious? And share the results.
Wonderful, wonderful. Okay.
70, for the people that are on Facebook, 71% of the people attending in our Zoom session are business owners and 29% are not.
Okay, and the following question?
And the following question is, can you repeat that? Ms. Industrious has control. The following question is, oh, have you attended previous sessions? And if you guys will take a few seconds to answer that question.
Okay. Wonderful, wonderful. Okay, so we have considered previously, we spoke about the importance of, as business owners, knowing what is happening with your books. It's very gratifying to see that 70% of you have already taken the other classes. For the small percentage that has not, these are available in the SBDC website and also on the Facebook page. So you can go back and review these other lessons. You can also download the PowerPoint presentation so that you have a well-rounded information, okay? Today, we're gonna talk about understanding the balance sheet and other financial statements. Balance sheet usually look like this. This is a general balance sheet. As you're gonna see here, it starts with the assets, then you have liabilities, and then you have stockholders' equity. You can have under assets, different types of assets. You have current assets, long-term investments, property, plant, and equipment. You can detail your assets, intangible assets, other assets. And as we're gonna see, I just realized I'm looking at it, but I'm wondering if if it's showing in the same side. But we're gonna see it. It is? Okay, good. The accounting balance sheet is one of 5 major financial statements that are used by accountants and business owners. And we have discussed some of the other financial statements, which are the income statement, also commonly known as the P&L or profit and loss statement, the statement of comprehensive income, statement of cash flows, and statement of stockholders' equity. The balance sheet is also referred to as a statement of financial position. Why? Because the balance sheet represents the company's financial position at the end of specified date, a specific time. In contrast with, for example, the income statement, which is going to take you from, say, the beginning of January until December, 12 months would be shown in that statement. The balance sheet is going to tell you at that day, whatever day it is, let's say, usually, say December 31st, is going to tell you what the company looks like at that specific time and place, okay? Because the balance sheet informs the reader of a company's financial position as of one moment in time, it allows someone, like a creditor, you're going to take a loan, you're going to ask for credit anywhere. That's one of the first reports they're going to ask you for from your company is a balance sheet. It allows them to see what a company owns as well as what it owes to other parties as of the date indicated on the heading. So it's very important that this report is accurate. It accurately reflects your business information. So it's something that if you have, as a business owner, you have an accountant, you have a bookkeeper that you can request at any given time. If your records are being kept up to date, you should be able to request this at any given time and look at for yourself, look at what that balance sheet is saying about your business. You especially want to do that before going to request a loan or credit anywhere. This is valuable information to the banker who wants to determine whether or not a company qualifies for additional credit or loans. Others would be interested in the balance sheet. Others who would be interested in the balance sheet include current investors, potential investors, company management, suppliers, some customers, that's interesting, competitors, and government agencies. If as a company you are interested in applying to be under the government contract program, then you need to have this as well. So it's important as a business owners for you to understand what the balance sheet is saying about your business, because this is almost like a resume that you're showing to potential investors, to those that you may be asking for money from, and you want it to look good. Now, the balance sheet equation, the accounting equation, not the balance sheet, the accounting equation that is used in the balance sheet is liabilities plus equity equals assets. And reverse that is assets equals equity plus liabilities. Remember, if you have any questions as I'm going along, feel free to ask them, okay? I would be happy to stop and consider those with you. Now, the balance sheet uses the double entry accounting, and that's called a T account. The double entry accounting means that you have debits and you have credits in that report. Debits are always are shown on the left side, and a debit can signify an increase in an asset. You notice that assets in the balance sheet were on the left side, and owner's draws. A debit can also signify a decrease in a liability, revenues, and owner's equity. So a credit is to enter an amount on the right side of the column. Normal entries to revenue accounts are credits. Liabilities normally also have credit balances. So we have to, when we're thinking about debits and credits in an accounting terminology, you can't think as a credit always being something good. And you can't think as a debit always being something bad, okay? So you'd have to kind of throw that out the window and think of debits means assets, credits means liability, and if a debit is used on a liability, what does it mean? If a credit is used in an asset, what does it mean? Okay, we're gonna consider all of that. Double entry accounting or bookkeeping is what's basically used overall. A double entry system requires that for every business transaction, there must be an amount entered as a debit in one account, regardless of which account, and the same amount entered as a credit in another account. So it's two accounts are impacted by that one action. In other words, every business transaction will involve a minimum of 2 accounts, maybe more. One or more of the accounts must have the amount entered as a debit, and one or more of the accounts must have the amount entered as a credit. Let's use an example. To illustrate double entry, let's assume that a company borrows $10,000 from its bank. The company's cash account must be increased by $10,000, and a liability account must be increased by $10,000. So you borrowed, so that means that you now are $10,000 richer, but it also means that you are $10,000 in the hole, so to speak, right? You owe $10,000. So to increase an asset, a debit entry is required because assets we discussed are on the left side, the debit side. To increase a liability, a credit entry is required. Hence, the account cash, which is an asset, will be debited for $10,000, and the liability loans payable will be credited for $10,000. Okay, so remember debits, left side, credits, assets, liabilities for the most part, okay? Any questions so far? Okay. It is common for inexpensive yet sophisticated accounting software, such as QuickBooks, and this is something that was discussed in the last training session. I was asked about other software besides QuickBooks, and there are quite a few, but I would like to bring to your attention that not all of them use the double entry bookkeeping system. I found, I did some research and it was interesting. So you need to be aware of those, it doesn't mean that it's wrong that when they're not using the double entry, one entry, but it means that you have to look, you have to dig a little deeper when you want to know exactly what is going on with your company. So double entry is pretty easy. It gives you an accurate picture. So when you're looking for accounting software, you want to make sure that they provide this kind of bookkeeping service for you. So usually though, on the double entry on softwares, you only have to do one entry at a time. For example, you prepare a check, it would automatically credit the account cash when the check is written. And remember, in this case, cash is an asset and it's a debit account. So if it's credited, it means that cash is taken out. And it also then requires that you enter, then you need to enter the account that is debited. So when you're writing a check in QuickBooks, you're gonna see the check format. So you write it just like you would write a checkbook. So that's the easy part. But then at the bottom, you have to expense out that check. And that would be your liability account. Whether it's for payroll, whether it's for taxes, whether it's for materials that you have to buy, whether it's for repairs on something, or whatever expense it is, then you have to enter it. You have to know what you're doing there and how you want to expense that account. And we're going to be considering later on, one of the things that we're going to talk about is payroll. So we want to make sure, not just with payroll, but with everything, that is expensed out to the right account. And this is very important for your balance sheet to accurately, and for any other statement that is produced for your company, accurately portray what your company is doing. So you want to make sure that either you or whoever is preparing your books for you is expensing things out to the correct accounts, okay? Keep that in mind. Debits and credits. So a debit means left side, or the left side of an account. Remember, we're talking about a T account. And credit means right or right side of an account. Asset accounts, which are on the left side of the equation, will usually have their balances on the left side of the account. And since debit means left side, asset accounts will have a debit balance and their account balances will be increased with a debit entry. Hence, a credit entry will decrease the asset's normal debit balance. So in an asset account, debit is good, credit is bad. Just keep that in mind. Liability accounts, which appear on the right side of the accounting equation, usually have their balances on the right side. And since credit means right side, a liability account is going to have a credit balance. To decrease a liability account, then a debit entry is needed. Stockholders' equity accounts, which also appear on the right side of the accounting equation, will usually have their balances on the right side. And since credit means right side, a stockholder's equity account will likely have a credit balance. To decrease one of these accounts, a debit entry is needed. So just kind of keep in mind that T, assets, debits, liability credits, equity credits, okay? And keep in mind that debit in this case is good, a credit in this case is not so good, okay? Very simplistic, but just, helping you to try and keep in mind when you're looking at the balance sheet, what you're looking at. So we said the assets are on the left side, debit side. What are assets? Anything that is owned or controlled by the company or by you as a business owner. Anything that has an economic value, that is tangible and intangible. So we have examples of assets accounts that can be reported on a company's balance sheet are cash. You have petty cash, temporary investments. You have accounts receivable, okay? And remember, this is one of the things that we discussed in the last training, accounts receivable, money that is owed to you, owed. Inventory, supplies, all of these are tangible assets that you have. Prepaid insurance is intangible. Land improvements, buildings, equipment, goodwill. Okay, so, and again, to reiterate, usually assets accounts will have debit balances, which means they're good. Types of liabilities. A liability is defined as a company's legal financial debts or obligations that arise during the course of business operations. Liabilities often will have the word payable in the account title. Rents payable, utilities payable, okay? And that tells you it's a liability because it's money you're dishing out. It's money that is coming out of your business. Liabilities also include amounts received in advance for a future sale, for a future service to be performed. Current liabilities include all liabilities that are expected to be paid within 1 year. And you have current liabilities, you have long-term liabilities. Any liabilities with a payment period of over a year are considered long-term. Current liabilities will include payments for debts, accounts payable, and other bills that are due to suppliers or other providers. Long-term liabilities refers to all liabilities that are not due in full within the year. Usually a loan will be a long-term liability. This group can include loans, deferred tax obligations, if you have a payment plan, and this payment plan is going to take over a year, then it will fall under a long-term liability, and any pension payments. Questions so far? Okay, so liability is things that you have to pay off, okay? Obligations that your business may have to others or other businesses.
I have a question.
Uh-huh.
What is considered goodwill? Is that referring to like a charitable donation?
Not necessarily. I would have to look that up to give you a correct definition of that.
Okay.
Okay. And
okay,
if you put your name in the chat
okay.
and answer the question, I will send you that. Okay.
Okay. Thank you.
Yeah. Remember, we're talking accounting. And that's why I stress not thinking credit is good and debit is bad, because sometimes we see these things and we think of them as our normal daily life, how we perceive that, but it may not necessarily be that. Okay? It's a terminology that is used that will encompass something much greater.
Okay, thanks.
Yeah. Okay, so we spoke of assets. Liabilities, remember the accounting equation? Liability plus stockholders' equity equals assets. So now we're going to talk about what is equity. Equity has no attached debt, okay? No liabilities, and it's an asset that can be sold. Equity can indicate an ownership interest in a business, such as stockholders' equity or owner's equity. Most corporations will have stock, right? A sharing of stock. If it's a corporation and you have more than one person, shares of ownership are called stock, and stockholders equity. Okay, that would be considered owner's equity would be the stocks that can be shared out to the different owners of the corporation. It can mean an owner's interest in a personal asset. For example, if an owner has a house that was mortgaged for $200,000, okay? And the loan is now paid up to $75,000. You paid it down to $75,000. Then you have an equity on that house of $125,000, because then that's actually, if it has no debt to that, you paid it up, it's yours. You can then use that. Many there are mortgage companies that will give you a second mortgage based on your equity on a previous mortgage, on a previous loan. So that is what equity means, is once you have paid off everything, okay, then what you have left is yours, is solid, that's equity. So let's do quick reviews. The equation that is commonly used, which is called the accounting equation, is assets equal liabilities and equity. Liability equals assets minus equity. Equity means equals assets and liabilities, or assets equals liabilities minus equity. Well, in this case, we know that it's assets equals liabilities plus equity, okay? So that is the accounting equation that your balance sheet uses. You have assets, you have liability, you have equity. What is the name of the equation commonly used? And that is accounting. Didn't hear it from anybody. So this is the accounting equation, okay? It's not necessarily for math or business, it's the accounting equation. And as I understand it, this equation or law is over 500 years old. It was invented over 500 years ago, and it's been used ever since because it works. Because it works and it's reflective of a business or a company at a specific time.
Carmen, before
Yes.
you continue, there was a question. Would payroll be considered long-term or short-term liability?
Short term, because it's paid weekly, bi-weekly, monthly, even yearly. It's within the year. It's within the year. It's a short-term liability. What does double entry accounting show? Double entry accounting shows you only decreases, only increases, increases and decreases, or none of the above. Well, we know that it shows, very good, excellent. It shows you increases and decreases, right? It means that it shows you your debits and your credits, okay? Double entry accounting, always think of the T form and that you should have both. When on paper, what letter does double entry accounting look like? That's an interesting one. T. I just brought it up. Yes, T. Very good. Very good. Okay. And cash is what type of asset?
Tangible.
Very good. Tangible. Tangible means you can touch, you can, it's right there. Intangible are things that you know you have, but it's not something that you can actually sit on a table and say, okay, this is it. Current and long-term applies to something else. Stock is what type of asset?
Intangible.
I'm sorry? Stock?
Intangible.
Intangible, exactly. It's an intangible. It's one of those things that you cannot touch, you cannot really, it's not something that you can say, okay, this is it, this is a stock, but it's something that refers to an amount of ownership that you have in a company. And yes, it will be in a paper eventually, but it's still intangible. Very good, very good. And which of the following is a type of liability? Come on, ladies. Everyone, you've been doing good. What is a liability? A gross, net, current, intangible?
Current.
Current, exactly. So we have current liability, we have long-term liability. Gross, net, intangible, those are accounting terms, but they refer to something else. Of the following, which is a type of liability?
Equity.
Long-term.
Long-term. Equity is something else all by itself. Remember, equity we said, that was what? Something is an asset that can be sold, ownership and an interest in a business, okay? So we were in where, 7th? Okay, see, so a liability, remember liability is that you owe. Think of liability as things that are not yours at the moment because you owe them. So we talked about long-term and current liability. So that term, when you hear long-term, you can associate it with liability. And we know liability is on the credit side of the equation, remember? On the credit side, and usually means you owe. Debit is asset. It means it's something that you have. I'm putting it very simplistic, but just so that you can, in your mind, when you hear these terms, you can associate them. What is the most true of equity? Once all debts owed on the asset have been paid off, the owner has ownership of the asset. Small businesses cannot have equity in assets. Large businesses cannot have equity in assets. Small and large companies must always share equity in assets. So what is the most true statement here?
A.
Very good, excellent. Once all debts owed on the asset have been paid off, then the owner has ownership of the asset and it becomes equity. Okay, very good, excellent. What percentage of an asset does an owner hold once all debts associated with that asset has been paid off?
B, 100%.
Exactly, 100%, 100%. Very good. And of course, we're talking of one owner. In this case, the owner could be the corporation, which is composed of more than one person. So, but the corporation would owe 100%. However, it's divided afterwards. Okay, very good. Okay, so we're going to talk now about.
Excuse me. Good morning. I have a question.
Morning. Sure.
What was the answer to the first question, please?
The answer for the first question, I'll give it to you right now. But the question was, what is the equation commonly used? And
Correct.
the answer is assets equals liabilities plus equity.
Assets equals liability.
Plus equity. Number two, the answer would be accounting. Number three.
But going back to question 2, is it inaccurate to say B?
I'm sorry?
Going back to question 1, isn't B correct too? Liability,
yes.
Liability is equal to assets minus equity.
See, but the accounting equation, as it's been known, is assets equal liabilities and equity.
Okay, I got you.
Just the, just what is commonly known for, say, 500 years.
Okay, all right, okay. Thank you.
Thank you. Thank you very much.
No problem. Okay, you're good on all the other questions, right?
Yes, thank you.
Okay, so let's go to module 7. So module 7, we're talking about the income statement. We're gonna consider the cash flow statement, capital statement, and budget versus actual. All of these involve money, of course, or the use of money in one form or the other. All of these are representative of your business at one time or another. And again, something that I want to stress, which I stressed the last time, and I'm doing this because as a bookkeeper, for many different businesses, for many size of businesses, a report is only as good as what you feed it. And that's why I am so happy that most of you are business owners, because it's your responsibility as a business owner to make sure that the information that is in that report is accurate. Many times we will see that business owners will say, oh, well, my accountant did that, or my bookkeeper did that, and I didn't know it. It's your business, it's your responsibility to make sure that that balance sheet is reflective of your business. And if it's wrong, then it's showing you in a bad light, and you don't want that. So that's why I am happy that as business owners, you're trying to understand this, because you need to be able to look at that balance sheet, read it, and say, does this really reflect my business? Can I really give this to someone else and be proud of what it shows, okay? Or be assured that it's a true statement of my business. So it's your responsibility to know that. It's not fair to an accountant or a bookkeeper to say, well, you were the one that did that report. Hello, we did the report based on what you gave us. So keep that in mind. It's your business. You should know where your business stands, Balance sheets are the best way of doing this. You should be able to ask of your accountant or your bookkeeper for a balance sheet at any given time during the year, because it reflects what that business is at that exact day that they do that report. And you should be able to then use that balance sheet to make some adjustments or to make decisions. For example, when we get to budget versus actual, you need to have that information, okay? I'm preaching a little bit, but it's what I see. Okay, income statement. So summarizes revenue, okay? Summarizes expenses, and notice that the term used here, summarizes. So it's a summary. It's not a detail. It's not going to tell you every single Tom, Joe, Dick, and Harry that you owe. It's going to give you a total of all your expenses. It's over a period of time versus balance sheet that is on one day, a snapshot of your company. Here you're getting a broader picture of your company. It measures financial performance. The income statement reports a corporation's net income for the period of time indicated in its heading. The income statement is also known as a statement of income, statement of earnings, statement of operations, profit and loss statement, or many just refer to it as a P&L. So when someone asks you, a banker says, I need you to give us a P&L, this is what they're asking for, okay? So basically they want to know how much you're making, how much you're dishing out, and then what is your net profit, which equals your net profit. Make sense? Any questions here? It's pretty basic. It's what you've made versus minus what you paid out, and that equals your net profit, okay? And it can be a month, it can be like for example, many businesses will run P&Ls to do their gross receipts at the end of the month. And that P&L should accurately show the income, what was taken in, okay? And remember, gross receipts means exactly that. What you receive gross is not necessarily your net profit. It's what you received, not taking into consideration what you had to pay out from that receipt. It's basically what you receive gross. Okay, cash flow statement. The cash flow statement reports a company's major sources and uses of cash during the same period of time as the company's income statement. In other words, it lists the major reasons for the change in a company's cash and cash equivalents reported on the balance sheet at the beginning and at the end of the accounting period. So you do a balance sheet January 1st, or let's say you do it December 31st. And you say, okay, June 30th, let me see a balance sheet. Let's see how we did in this last 6 months. So it's just going to show you in December 31st, your, let's say your cash was shown as $150,000. And in June 30th, you only have $75,000. And you're like, whoa, how did that happen? Then the next thing you want is a cash flow statement, because it's going to show what happened to that money during that 6-month period. Where did that money, how was that money distributed? How did it flow out of your company? Okay. The cash flow statement is needed because the income statement reports the revenues earned and the expenses incurred using the accrual method. We talked about accrual versus cash early on. These amounts are different from the amount of cash received and paid. Also, the company's annual income statements might report 3% of a new building's cost as depreciation expense, but the company may have paid cash for 100% of the building cost in the year it was constructed. So let's talk about this a little bit. We talked about accrual, okay? Accrual method, it takes into consideration whether it's your earnings or your expenses at the time that they are incurred, okay? In other words, you entered into a contract with someone, and that contract is said to be going to pay you $200,000 under the accrual method. $200,000 go in the book immediately. You have not received those $200,000, but it was incurred. Okay, it happened. You signed for it. It became something that is going to come to you at that date. So it's going to show up in your books at that date. Cash method, that $200,000 is not going to be posted to your books until it actually, you make that deposit in the bank. That money is in your hands, you make the deposit. Then why accrual is better? Because it will show the health of your company. It will show a banker who's going to look at it is going to say, okay, you know, we can take a risk on this person because he's showing that the income that is going to come in is this much. Okay, the bad side of it, you notice that the company's annual income in the income statement is going to report 3% of a building's cost as depreciation, when in reality you already paid 100% for that income. So it's not it wasn't showing accurate picture in that sense. The cash flow statement is going to show that. Okay, since cash is critical for a company's operation and decision making, it's necessary to have the cash flow statement. How many of you had heard of cash flow statement before? Anybody who hasn't?
I have.
Okay, good. I'm glad to hear that. So, go ahead.
I have a question.
Yes.
So an income statement is assets versus liability, not including equity? I don't think that's right.
Assets and liabilities, yes. Income is not even assets and liabilities. Income is money coming in, expenses paid, net profit. So
so it's not showing equity?
No.
Okay.
Okay. It's a very simple statement. And basically what it shows is what you did, what came in and what went out. Okay. Whereas, oops, I went too far. Sorry. Okay. For a period, but balance sheet will show you one space in time. Now the cash flow is going to give you remember we said in the income statement, what you get is total amounts, okay? Summarize of that. And it would be, is the equation of income minus expenses equals net profit, okay? I'm trying to think if it would be correct of me to say that net profit equals equity, but not necessarily, because we're talking about it doesn't take into consideration other assets that you may have, intangible assets and all of that. This is talking about what came in, revenue. Okay, so net profit is just income minus expenses, net profit. Does not equal equity. Did I make it more confusing for you, or is that clear? Okay, I'm hoping that it did. Cash flow statements is organized into 4 major sections. Your operating activities, it converts the items reported on the income statement from the accrual basis into accounting into cash. Operating activities. Now what's happened
last week?
Huh? I'm sorry?
Oh, sorry. That was an error.
Okay. Investing activities reports the purchase and sale of long-term investments and property, plant, and equipment. Financing activities reports the issuance and repurchase of the company's bonds and stock, payment of dividends, borrowings, and repayment of short-term and long-term bank loans and other debt. and any supplemental information, exchange of significant items that did not involve cash, and reports the amount of income taxes paid and interest paid. Cash flow statement. So as a bookkeeper, I cannot give you a cash flow statement. That's something that you would want to request from your accountant. As a bookkeeper, I am not going to be taking all of this, keeping track of all of this. A bookkeeper is going to keep track of the daily in and outs of your company. And this is something that we spoke about in one of our previous sessions also. A bookkeeper and an accountant are two very different things. A bookkeeper takes your daily operations, your daily ins and outs, and puts them in a journal, keeps those, posts them in journals, posts them to the correct income or correct expense accounts. And then at the end of the year, we make sure that everything is balanced. When we do the balance sheet, we have to provide balance sheets, and we have to provide P&Ls, income statements, to the accountants, and we have to provide even more reports or more detailed reports of that to the accountant. Then the accountant takes all of that information and decides, and then goes into all of this, okay? Then the accountant can give you a cash flow statement. Then the accountant can give you a more accurate P&L, because he may decide that the bookkeeper expends something out to the wrong account, that if it's expense to this account versus the one that she put, which is maybe simpler, the owner can get more benefits, can get more tax benefits at the end of the year. So those are decisions that an accountant makes. They have been trained, they have gone to school for that, they know the laws, which are many, okay? As a bookkeeper, that's not my job. I don't do that. My job is making sure that, okay, we have a construction project. What jobs do you have? What things that you bought are for this job versus that other job? How many hours should I put that this employee worked in that job, and how many hours for this other job? I make sure that your payroll is correct. I make sure that people are paid on time. I make sure that your taxes, payroll taxes, are paid on time, that your gross receipts taxes are paid on time and correctly, okay? I make sure that your accounts are reconciled on a monthly basis, so that what you see in your bank register is correct, okay? That bottom line is what you really have. So these are what as a bookkeeper I do. And then an accountant will take all of that information that then is kind of condensed into a few reports and give it to them. Many times an accountant will come back to a bookkeeper and request explanations. What does this amount signify? What went into it? Or why did you put this expense to that? Or why did you consider this a revenue or income when it was maybe something else, okay? So these are the things that, and the reason I explain this is because many times business owners would want their bookkeepers to make those kind of decisions or to give them that kind of input, and they're shortchanging. You're shortchanging yourself if you do that. You need to go to someone that is an expert on that, okay? So keep that in mind. A bookkeeper is not an accountant, and an accountant is not a bookkeeper. It's very interesting that accountants, when they're given if they try to do bookkeeping, they can't do it. They can't do it. It's very funny because I have met that many times, because they're not trained to look at the little things like that and to post them the way that they're supposed to be posted. They're trained to take that information, that bunch of information that is given to them, that all the little bits have already been done, and then they take that and convert it into what a business owner needs to know. So that's, again, me preaching. I apologize.
I have two questions.
By experience. I'm sorry?
Okay. Is the accrual method preferred over cash? If so, when is the best time to use the cash method?
Okay, we discussed that in the previous session. If you weren't here for that, my suggestion is look it up in either in the website or on Facebook. I believe there's a recording. There should be a recording of the session. And we discussed that at length, okay? Cash versus accrual. Most banks, for example, are going to ask you for P&Ls, balance sheet, and the accrual method is the preferred method, okay? However, most small businesses use the cash method because it tells them what's happening there and now, okay? And they want to know that. But reports are preferred in the accrual method. And one versus the other was considered before, so my suggestion is to go back to those, okay?
Okay, next question. I think it's saying, will the bookkeeper do the IRS forms?
The 1120s and the 1040s, if it's open, no. A bookkeeper should not do that. An accountant. And I'm very, very specific about that. Again, you're shortchanging yourself if you are allowing a person that is not an authority on that subject to prepare that for you. You may be shortchanging yourselves in many loopholes that you can take so that you pay less taxes. Accountants are trained to know those. They keep up to date any changes in the law they receive, so they will know what is the best way of reporting something. And I'm not advocating anything wrong, but I'm saying the law is set up so that it takes into consideration special situations, and especially now because of this whole COVID-19 pandemic, there have been so many things that you need to keep up to date when you do your taxes at the end of the year. Right now, there's a law that they're trying to put into effect, or they're trying to make it a law, and it's regarding payroll and having to pay any one of your employees who contracts COVID, that you have to pay 2 weeks, the 14 days that they need to be out quarantine, that you have to pay them for sick leave. And it's called COVID leave, and it's a whole totally different thing. So no, you should not have someone that is not an expert do your taxes, okay? My suggestion, my strong suggestion to you. If you are a business owner, you want to make sure that you get the most benefit of the laws out there for you, and accountants are trained to do that, okay? A bookkeeper is not an accountant. Okay, some investors believe that cash is king. The cash flow statement identifies the cash that is flowing in and out of the company. If a company is consistently generating more cash than it is using, the company will be able to expand its operations, of course, replace inefficient equipment, increase its dividend, buy back some of the stock, reduce its debt, or even acquire another company. All of these are perceived to be good for stockholder value. If, however, your cash flow statement shows that more money is flowing out than coming in, then you have to take stock of that and make some hard decisions. Okay, one of the other financial reports is a capital statement. And we have a very simple summary here of what a capital statement looks like, okay? It's concerned with or keeps track of the items that are going to last for longer than 1 year, like long-term assets of a company, for example, buildings. Capital statement is the document which presents the opening balance of the capital at the first line, and then any kind of addition in shape of investment or profit earned during the accounting period is added in the next line, arriving to a total balance of capital. Okay, so you have the beginning, anything that is added, and your net income. Deductions in form of withdrawals or loss of business are then subtracted from the total balance of the capital, which in turn helps you to arrive at the final balance of capital at the end of the accounting period. So notice that this capital balances, here you started January 1st, and here you ended December 31st. So January 1st of the following year, you will start with the same amounts, okay? And then you will start the process all over again. Again, this is something that an accountant should do for you. I brought it up as a bookkeeper and in keeping your books, because you need to know that these are reports that are available to you and that you should make yourself familiar with, or you should see at least once a year from your company. And that's the whole, not the whole, but a good part of the reason for this training, and it's called basic bookkeeping, is for you to familiarize and be knowledgeable about your business, be knowledgeable about the books in your business. You don't have to be the expert. You don't have to know all of it, but you have to know the basic, so that when these reports are presented to you, so that when your bookkeeper is doing all of this, and you ask for that balance sheet, you ask for that P&L, you ask for your bookkeeper, for your accountant, for the cash flow, that you know what you're looking at, okay? And it's your responsibility as a business owner to do that. I see questions. No? Okay, so we go ahead. So we discuss all of these. Now, budget versus actual. So budget is basically you're planning for future expenses and you're considering previous statements. Okay, actual is when the expenses are incurred and unexpected costs or changes happen. The differences between the actual amounts occurring and the budgeted amounts are called variances. These variances can also signal new problems that need management's attention. So it is healthy, it's a healthy practice for you to start your year and do a sit down and think, okay, what do I want to do this year? You got your December 31st income statement, you got your cash flow, you know where your capital statement, what it looks like, you have all of that, you're starting your year. What do you want to happen this year? And you have to take the time to do this as a business owner, okay? So you wanna create a budget. And a budget basically is, this is what I envision based on what I'm doing now, based on what I am working towards, okay? And this is what I hope happens. But you did your budget January 1st, 2020, and what happened in March? COVID-19. So there, and then COVID-19 started in March, we said, oh, that's gonna blow off in a couple of weeks. We're six months down the road and it's still there. So somewhere along that line, you should have sat again and say, okay, let me see what my actual is. This is what I budgeted. This is this is my plan, what I wanted it to be this year. But instead, this is what is happening. So now, how do I move forward? Do you see why it's so important for you to do this? You cannot always be reactive in your business. You have to be proactive. You have to have that planning ahead, okay? You cannot oversee, there's no way for you to know that COVID was coming. There's no way for anyone to know, to have known how COVID was going to affect the economy, how it has affected every single industry in the island. But then you just don't sit there. Then now you have to make a new budget. Okay, so that's not, scrap that one. It's not happening. Let's do another one. Let's do another
question. When you say signal some new problems, are you meaning that if you went over your budget, that's what needs management's attention?
Well, yes. For example, what caused those changes? What caused those changes? Was it a lack in management oversight? Was it maybe, let's say, a job that you had budgeted to be expensed at 150,000 and you are already in 170,000 in expenses? Sorry about that.
Or you didn't budget correctly, or?
You didn't budget correctly, maybe. Or if the COVID-19 happened, things are not coming into the island the way they were, and all of a sudden what cost you $3 is costing you $5 now. Even in building, in construction, let's say. So that has to change. Now your budget has to change. You understand how that can work?
Yes, yes, thank you.
Many things can impact your budget. Some may be within the organization. Many, probably the majority, are from outside of the organization. But you want to look at everything because you want to see if there's something within the organization that is causing this. And this is where how a good business is run. So the people that are, whether it's you as a sole business owner or the corporation and its officers, need to be looking at these things to make sure that your business at the end of the year is going to turn a profit or at least break even. This year, I'm sure what everybody is praying for is at least break even, you know?
Right.
Not
so just one more question. So is it prudent that if you have another area that you're not expending, can you transfer those funds, even though it's a budget, can you take it from one other account and to supplement that account that you've been over in your budget? Is it?
You as a business owner those are decisions that you as a business owner need to make.
Okay, got you.
Yeah, definitely.
Right, thank you.
Yeah.
Because just to maintain your budget for the year, because you may have an area where you budgeted for, but you're not expending as much, but just to keep it within.
But a budget, remember, a budget is not written in stone.
Right.
You're planning for.
Sure.
Okay, so that tells you that variances can happen. Okay, whether they occur from outside influence or whether you cause them to happen.
Okay.
Okay, say that you were planning on, you were a construction company and you have this many jobs, and then this other job comes that is like the job that you wanted. This is really going to put your company on the map. So you had budgeted out based on 1, 2, 3, but now you want to add a fourth. So like you said, now we have to spread that, cut that pie differently. So you have to rebudget things, okay? And again, I'm speaking in simplistic terms. Of course, a lot more has to be taken into consideration, but it's just the thinking process that you have to have for this. But it's important that you plan. Don't handle your business by the seat of your pants, please.
All right, thank you.
Plan. This is what this is all about. Any other question? Okay, so let's review what we have considered. This time, I'm giving you the answers right here. You've been so good. What does the income statement summarize? It's a financial statement that measures the company's performance over time. So it's your revenue earned and expenses incurred, okay? Your income statement is your revenue and expenses, and then it gives you the net, okay? The income statement also includes which of the following? How the company incurs its expenses over time, how the company earns its revenue over time, how the company incurs its expenses and earns its revenue over time. So that would be the correct one, okay? It measures the company's performance over time. So what did you do for that time period? Again, an income statement or a P&L can be also requested at any given time. You don't have to wait until the end of the year. You don't have to wait until the end of the quarter, okay? Halfway through the year, you want to see how you're doing because you want to go into this budget versus actual. Then you request that income statement, you request that balance sheet. How many financial statements are there? 2, 6, 4, 7. The 4 financial statements are cash flow, balance sheet, income statement or P&L, and statement of retained earnings. So each one, there is 4 of them because each one of them give you a different angle of your business. So you just don't want to take one and say, okay, that's it. No, you want to see all these 4 report statements financial statements of your business. Cash flow statements show what? How the money comes in to the company, how the money flows out, how the money comes in and flows out of the company. The way that, as the name states, this statement shows the activity of money in both directions. Okay, so cash flow statement, very important for you to have at any given time in the year of your company. Capital statements keep tracks of items that last for longer than how many years? 10, 7, 5, 1. Items that last longer than 1 year are considered long-term items. Remember the question someone asked? Payroll expenses, those are short-term, those are current, okay? So those are expenses that happen immediately, even if they are paid once a year, but you're still within that year, okay? What is an example of something that would be on a capital statement? A ream of paper, pencils, pens and pencils, a building, printer carriage. So items that last longer than 1 year are considered long-term items, long-term. In this case, we're talking about capital. Long-term, the same rule applies to long-term liabilities, okay? Buildings are an example of such items. So in this case, we're talking about assets, okay? Capital is asset, but it would also, it would be considered long-term item if it's gonna be around for more than a year, okay? What is budget in regards to financial statements? Is the amount planned for ahead of time, okay? Not what was actually realized, not A and B. Budget is amount planned for ahead of time, and the actual is the amount that's realized. So again, plan means that you're hoping and you're praying and you're gonna work towards that, but it's not necessarily what is going to happen. And that's why it's so important that you are aware of how that budget is going throughout the year, so that you need to know what, if you need to plan differently from what you were thinking, okay? What is actual in regard to financial statements? The amount planned for ahead of time, the amount that was actually realized, which is the answer. The budget is the amount planned for ahead of time, and the actual is the amount that is realized. Basically the same, okay? But here we're talking about two different, what is budgeted and what is actual, okay? So one is what is planned, the other one is what actually happened. Okay, any questions before we go here? Any questions so far? Everybody good? We're good in time. What we are going to consider next week is week 4, and we're gonna talk about payroll accounting and terminology. What are the employer's liabilities in this case, tax expenses, the reports that you have to make, the when you have to make those reports, okay? And these are things here, this is things that your bookkeeper should know and should be keeping her finger or his finger in the pulse. They will know these have to be done. Why? Because it's gonna cost you money if not. Employee taxes, when, why, and how, and reporting. I see a question? No? And we're also gonna consider end of period procedures.
Yeah, there is a question.
Okay.
Well, before I give the question, please don't leave immediately, because we have a couple of poll questions that we would like you guys to answer before you leave the webinar today. And our next question is, whose responsibility is it to close out the accounting period? The bookkeeper or the accountants?
The accountant. I will put that on the accountant.
Okay.
And it's usually done by the accountant. And a good accountant, which then always happens, will inform the bookkeeper of this, okay? But that is the accountant's responsibility. Because once a bookkeeper, remember, the bookkeeper is compiling, we're compiling all this information that happened throughout the year, and then we give that to the accountant. And remember, I mentioned a couple of times, the accountant may make changes to how you have posted certain things, to how you have expensed certain things. So I cannot close the year, because once I close it, then he cannot make those changes. He's the one that closes the year. Once he's revised everything, he's reviewed and revised anything that needs revision, then he can close it. And then, you know, we start the year fresh.
Next question. What does the abbreviation PL stand for?
P&L?
I think it should be P&L.
Profit and loss. Profit and loss statement. Profit and loss is the same as the income statement. What was your revenue? What was your expenses? Net profit.
Okay. Who does the adjusting entries?
A bookkeeper, if he or she is knowledgeable, can do adjusting entries. If he or she is not comfortable, then they should not do it, because adjusting entries can impact more than one account, and you want to make sure that you're doing it right. Again, as a bookkeeper, I always look to see what is the best possible scenario for my client. Okay. Many times I've had meetings with my clients and say, listen, you're expensing this like that, but you should probably do it like this. And I always say, you can ask your accountant if you want, but you know, I know what I'm telling you, why I'm telling you that, but feel free to ask your accountant. And usually the accountant will say, yeah, that's okay. Go ahead and do it like that. But if you don't know how to do it, then don't do it, please. If all you know how to do is payroll, then stick to payroll. If all you know how to do it, because many businesses, large businesses, have separate accounts payable departments, and that's all they deal with. Have separate accounts receivable departments, have separate payroll departments, H&R, okay? And they know what to do there, but they don't know how to handle the others. So if you are working in that scenario, then stick to what you know, and don't make problems for others. Sorry, but again, I'm going by my experience, and it can take a long time to undo some of the bad postings, bad reportings that have been done. It can take a long time, and if I take a long time doing something, it's going to cost you money. So you want to make sure that it's done the right way. Any other questions? No? Okay, so we are also going to be considering next week end of period procedures, depreciating your assets, reconciliations, bad debt, and posting adjustments and corrections. Okay, so we'll talk a little bit more and be more detailed on that next week. Payroll and accounting is my pet peeve. Oh my goodness. So I'm gonna have a lot to say about this. It's very, very important that it's done correctly. The laws are very straightforward. And again, you know, you have to know what you're doing. So now the poll questions. I hope that you enjoyed the presentation, and I hope that you will be here for next week. And again, if you need to, if you weren't here for the previous two, you can access them either at the website or at the Facebook page. I hope you have a good rest of the week.
Okay, the polling question says, was the level of the presentation too easy, just right, or too difficult? And right now, for those people on Facebook, you're missing out, but I'm going to end the poll now. And the results say 95% of the people say the presentation level was just right. 3% said too difficult, and 3% said too easy.
Okay.
Okay.
I'm happy to hear that. I'm happy to hear that.
All righty. And now we're going to do our last poll. Oh, no. How likely are you to finish the series?
Where are you coming from?
Oh, where are you located? Oh, last but not least, where are you located? Man, those numbers are racking up quickly. All righty. And out of all of those people, we'll give you 2 more seconds. The poll is ending now. 56% of the people are from St. Thomas, 37% are from St. Croix, and 7% are from other. Very good. Very good.
Welcome every single one of you. And I'm really, really, really happy. I've been ecstatic over the response for these trainings because I really want you to know what is happening with your business, and I want your business to succeed. That's the whole criteria behind this. SBDC wants your business to succeed, and we want to help you to make that possible. And knowledge is power. Keep that in mind, okay? So I hope I see you next week, and I hope you have a wonderful rest of the week.
Thank you. Okay, on behalf of the Virgin Islands Small Business Development Center, I want to thank all of you for attending today's session, Basic Bookkeeping. We look forward to seeing you next week, Tuesday, for Webinar Tuesdays with Ms. Carmen Acevedo Adams. Remember, you have to register for each session. You can either register on our Facebook page or in our e-portal. And there are 2 more sessions left, so we look forward to seeing you in these next 2 sessions. And with that, we want to thank you all for attending, and do have a wonderful day.